Hello, Business 630. This is Professor Hassey. It's Sunday, November 21st, and this is an introduction video to our case study number 2, Capital Budget Risk Analysis. The case is now posted to Blackboard. It's due a week from today at midnight on Sunday, November 28th. It is to be in spreadsheet format only. No PDFs, spreadsheet only. Before we get to just walk through the case, let's go and pick up the spreadsheet of example that we looked at in our week number 4, both in our lecture video and our Friday update video. Here's that spreadsheet. It's called Solutions Week 4 in-class review. And in this spreadsheet, we walk through the calculation of weighted average cost of capital, determining the after-tax cost of debt and the cost of equity, weighting it to the capital structure of the company, and we get a weighted average cost of capital. We inputted that cost of capital into a spreadsheet analysis here. This is a 10-year depreciable life analysis for an investment of $1 million with a working capital rate of 12%, a tax rate of 30%, and we did this analysis in our Friday update video. Also in that analysis, this is called the base analysis. We determined the return in dollars, net present value, return in percentage, internal rate of return, return in a ratio, the profitability index, and return in years, time, 4.94 years. Now what we're going to do is we're going to pick up the risk analysis of this project. We already completed in that Friday video the scenario analysis, where we took different output scenarios and determined those NPV with all the other variables of the case staying the same. And we weighted those scenarios by the probability of those occurring. And we came up with a weighted net present value based on the different level of outputs in this project. The second form of risk assessment or risk analysis is called a sensitivity analysis, and that's what we're going to do today. As we do this analysis, you'll note in this graph, it will populate with the information I put in this chart here. Again, for purposes of the case number 2, all I expect you to do is this sensitivity analysis here. You do not have to worry about putting a chart in this analysis. If you want to, it's fine, but it's not required. You just want to, I just want to see this as part of your sensitivity analysis in case number 2. Now, what is a sensitivity analysis? A sensitivity analysis is to change plus or minus a certain percentages, a change of key variables to the case or to the project. In this sensitivity analysis, the 3 key variables designated by this project is selling price per unit, variable cost per unit, and weighted average cost of capital. But these variables can change depending on the project, depending on the culture of the company. So please note in case number 2, what your sensitivity variables are. The sensitivity analysis is to take the percentage change of each one of these variables one at a time and see how they affect the net present value of the project. In other words, I'll change selling price per unit. What's that, the NPV, and so on. So let's begin this. We go back to our base case, which we've already completed here. I'm going to now change. Notice our standard deviations right here, selling price per unit, variable cost per unit, and WACC, and 5 plus or minus 5, 10, or 15%. Here's that chart we just saw. So I'm now going to change the selling price per unit by negative 15%. So here's the selling price per unit, which is $20. I'm going to put in this cell equals $20 times 0.85, and I get 17 bucks. Why 0.85? That's a 15% reduction from 100%. So instead of taking 100% of $20, I'm taking 85% of $20, which is 15% reduction in selling price. That now is $17. It fits into my formulas already set up in my base case, and I end up with a net present value of $123,418 for a 15% decrease in my selling price. So I just put that here. 123,418. There it is right there. Notice I didn't change any other variables. I didn't change outputs. I didn't change other costs. I didn't change percentages. All I did was change the selling price by lowering it by 15%. Now for the next one, I'm going to lower it by 10%, which is 0.9. And now I get 250,545 as an NPV. You don't have to worry about these other ones. They'll probably pop up anyways, but I'm just concerned about what that does to the net present value profit return. 250,545. Notice you'll start seeing a line being populated in my graph. Now we go back, a 5% deduction. That's 0.95. 377,672. And you know, oops, 377,672. And you know, oh geez, excuse me guys, it's Sunday morning, I'm a little punchy. Okay. We need to start over again and get a cup of coffee here. There we go. And notice, you know, I'm doing this correctly. The line is staying straight of the graph. Notice it's straight. It's going at a different slope, but it's going straight. If I put in 477,672, watch what happens to the line. It does a little curve. It means something is amiss in my number. A straight line would indicate the way the percentages are. They're in increments of 5%. So that's what your key is to know you're doing this correctly, is when you see the line staying straight. At 0% change, that's our original base analysis, which we go back to $20. And that's our original number of 504,799 with no changes in the selling price, 504,799. And there we go. Now we go and increase our selling price by 5%. Notice at a lowering of selling price, we're making less money, and it should be going up in increments. So now we go back to our base case analysis and increase that by 5% times 1.05, which is 5% over 100. And we get a 631,926 NPV. There we go. Now a 10% increase times 1.1. Now there's a way you can do a pivot table on this and get really fancy and not have to go step by step, but for the sake of us, and a lot of us are beginners on this, we're going to do it this way. It's a lot easier. You just do it step by step, like putting a puzzle together. And now we have a 759,054 at a 10% increase in selling price. That line is still straight. And then finally, a 15% increase in selling price, 15,886, 181. And there it is. So now we've completed the sensitivity variables for the selling price. what happens to our profitability if we change the selling price exclusively by these ranges of percentages? And you notice the range from top to bottom is about $762,763. And that's indicated in the severity of the slope. The higher the range, the more severe the slope. The smaller the range, the flatter the line. And there we have it. So now we go back to our original $20 selling price. And now let's do the variable cost side of this. The variable cost per unit, let's adjust those variable costs by these various percentages. Our variable cost is $8 a unit in our base case. So we go to $8 equals 8 with a 15% reduction times 0.85. Naturally, now we'll probably make more money because we're lowering our cost. Yes, it goes to 680 with a 15% reduction in variable costs. That gives us a 656,471 net present value. And now we'll do that just like we did for the selling price. Notice this is the only variable I'm changing. So a 10% reduction in variable cost, 0.9, 605,914. And now we start the second line coming. It's going the other direction because it's an expense. Now a 5% reduction in variable cost, 0.95, 555,357. 0 is still 504,799 as our original base case. And now we can see the line really taking shape and it's still straight. So we know we're doing something right. Now we increase our variable cost by 5%, 1.05. That's 454,242. Now we're making less money because our costs are increasing. 454,242. Now a 10% reduction in variable cost is 0.1. And now it's 403,685. And then finally, a 15% reduction in our variable cost, or increase in variable cost, 1.15 up to 920, 353, 127. So now we've done the range of just showing the net present value with an increase or decrease in our variable costs. And notice the range here, top to bottom, is only $303,344, which means, as you can see, the line is a little bit flatter than the revenue line. And this point where this meets is naturally the 0% reduction, or where we have the original base case at 504,799. So that's the variable cost rate. Now let's go back to our base case and put the variable cost back to its original amount, $8, and we go back to 504,799. Now what we're going to do is we're going to change plus or minus the weighted average cost of capital. Well, the weighted average cost of capital in this particular case is 8.1%, which we calculated way back here. So now we're going to change this cost of money by 15 and so on. So this requires a little bit more technique, and watch what I do. Remember, 8.1 is our number here. So we're going to take that number and multiply it times 0.85, and we get 6.89%. That's a 15% reduction in our cost of capital. So now we have to take this percentage and insert it down here into our discounted cash flow formula, where we use the original 0.81%. So 689.0689 is now the discount rate. And naturally, with a lower cost of money, we should be making more money. And we do. 600,855 at a cost of capital 6.89%, which is a 15% deduction. 600,855. So now let's decrease our weighted cost by 10%. So we'll go back here, times 0.9, and that's 7.29. Now we'll put 7.29 back into our equation. And we get 568,147. Cost of money goes up, we lose less money, make less money, 568,147. And now we begin to track that line. Notice I didn't change selling price, I didn't change variable costs, I just changed the WACC. So now a 5% deduction in our original WACC is now 7.7%. So we put that into our discounted cash flow problem, 7.70. And now we get 535,611. A zero change is still 504,799. And as you can see, there's our line. It's looking pretty good. Now we increase our WACC by 5%. So now we're going to increase this by 1.05. And now we're going to be losing us money because our cost is going up. So that's now 8.0851. 474,138 is our net present value. I know this seems kind of monotonous, but this is a good way of seeing how it works. 10% increase in our cost of capital. 8.91. 445,090. And finally, a 15% increase in our cost of capital. Now, why would you do this? Because should money change or expand or get more expensive or cheaper during the course of the 10 years, we could want to refinance this capital position. We just get a feeling of what the cost of money is as it's changing over the course of life. This is a very important variable of understanding your cost of money. So 9.32 is a 15% increase in our cost of capital. 932, 416,171. And there we go. And now we've completed that line. And notice again, from top to bottom, the range is 184,684, which is smaller than the variable cost, which is much smaller than the selling price. And note the line is a lot flatter. And there is a chart of the different sensitivity NPVs. And here it is in a graph format. Some people like doing a graph because you can say, oh yeah, I can see. Notice, you know here that the most sensitive variable with the greatest range is naturally the selling price per unit. It is the greatest slope, which means the greater change. So naturally, your selling price per unit is your most sensitive variable. If you have to change your selling price from the original $20 to sell those 25,000 units you need every year, that variable changes the most your profitability, up or down. And that tells you something about that variable. And contrary, variable costs, WACC, gives you a different interpretation of your profitability as things change over the life of this project. So remember, when you're all done, go back to the original amount, put that back in, put that back into the original discounted cash flow, 0.810, and everything is now back to normal. And now we've completed our risk analysis. And we'll talk in week 5 coming up on our lecture video on Tuesday of this coming week. We'll talk what this data tells us, because in your case number 2, all you're going to be doing is crunching the numbers in this information. In the electrics case, which is being posted early this week, and we'll review it in our lecture video on Tuesday, you're going to have to be doing this analysis and then answering questions and interpreting, writing your interpretation of what this tells you. And that's what we'll talk about in week number 5 of our class lecture. But here's this. I'm going to post this to Blackboard. This is a wonderful template. Make sure, as I mentioned on Friday's video, when you do use this template, you're going to have to adapt all this information to the information given to you in another project. And that other project is case number 2. So let's take a look at that right now. Here's our case number 2. It's a capital budget analysis where you're asked to provide a base case analysis of the net present value, the internal rate of return, profitability index, and payback in years to determine whether the project is feasible or not. Is it going to make money? All the work is to be in a spreadsheet format, just like we've shown this past week. And also, in addition to doing the capital budget analysis, you're also to prepare a risk analysis for scenario and sensitivity. When you're all done with crunching the numbers in the format that we've just shown, I ask you to just give me a simple answer on your spreadsheet. In your opinion, is this investment approvable? Would you approve of this investment going forward with the investment? In the case of case number 2, it's an investment of $700,000. A simple yes or no is sufficient. So I want to see, after you've done all this, a yes or a no on your spreadsheet telling me your interpretation. Now, in the electrics case, you're going to be writing about 3 pages about your interpretation. But in case number 2, all you have to do is write a simple yes or no. The case is a 7-year project with an investment of $700,000. Before you even begin the project, you have to determine the cost of capital with a debt to assets of 70%, an interest rate on the debt of 6.5%, a current risk-free rate of 1.65%, a current market premium rate of 8.5, and a beta of this specific company 1.3. Prepare the after-tax cost of debt, prepare the cost of equity, weight it to the capital structure, and you get your weighted average cost of capital or your discount rate for your problem. And then you begin the analysis. Again, $700,000 year 0 investment over a project life of 7 years, depreciated at $100,000 a year to a salvage value of $55,000. Your working capital base is 8%. Your selling price per unit is $45, which is going to inflate at 2% after year 1. Your fixed operating costs are $75,000, which is going to inflate at a 1.5% rate after year 1. Your manufacturing costs or variable costs in year 1 are $35 per unit, and that also is going to inflate after year 1 of 1.5%. That's your base case analysis, and those are the variables you need to put together to determine NPV, IRR, profitability index, and payback in years. Your scenario analysis is going to determine a base case, which is 40,000 with a probability of 55%. Your best case scenario is 48,000 units per year with a probability of 20%. And your worst case scenario is 32,000 units a year at a probability of 25%. Prepare a scenario analysis based on those different operating levels over the life of this project. Your analysis, like we just discussed, has the same percentages, plus or minus 15, 10, and 5%, but your sensitivity variables are 3 of them: selling price per unit, variable cost per unit, and fixed costs. Those are your 3 sensitivity variables to prepare a sensitivity analysis chart at the NPV levels of changes in those 3 variables. Again, your spreadsheet is exactly what we just did over the last week in our class. Follow that format, insert the variables, crunch the numbers, and let's see what we come up with for case number 2 due a week from today, November 28th. Going forward this week, my next video will be Tuesday, November 23rd, where I'll introduce some more discussions about sensitivity analysis, some more interpretations of what it tells us. We'll also talk about the electrics case, your Business 630 case assessment, which is due the last week of class. It's a combination of case number 2 and a paper, spreadsheet and paper, to overall look at an analysis for a real world company, not your company that you picked, but a company that I pick, and give you the information to formalize. And we'll introduce that in week 5 coming up. I'm working on your case number 1 grades. They'll be all posted by this evening, Sunday. If you have any questions, let me know, but everybody's doing pretty well on that, so I'm not too concerned about that. Now we concentrate on case number 2. So thanks, everybody. Hope this helped. Good luck with your case. And I'll be posting a lecture video this Tuesday, and I'll be available for student hours, not Thanksgiving Day, Thursday, but I will be available for student hours during the course of the week. If any of you want to chat, I'm going to try to probably announce it in my Tuesday video, maybe a time on Friday or Saturday of the Thanksgiving weekend. If anybody wants to come and talk to me on the Zoom, I'll see what my schedule allows and see if we could make that. If not, you can just post questions to the discussion forum or send me an email. Have a great rest of the weekend, everybody, and I'll talk to you soon. Adios.